Okay, we're just looking at the inflation calculator for Australia. So we've got $1,000 in 1960, and that's going to be like a relatively valued for 2023. So in comparison, the same value of $1,000 in 1960 would be like $17,258.89. So that's the compounding depreciation of the dollar in the last 83 years. 63 years, sorry, not 83. So you got 1960 to 2023. So you got 63 years, and the value of the dollar has decreased by, it says 63 years there, by 1,625%. So, and that's an indication is that you can't save yourself, you can't save for retirement, because it just doesn't work. Because if inflation is running at, say for instance, even if I put in, we'll just make it more simple. So if we put in 2021, and then we'll just say you saved up $100,000, right? Hang on, enter that. That $100,000 from 2021 to 2023 would have to be almost $110,000 to have the same value. So basically what that says is that you've lost 9.6% of your purchasing power. You know, if we go back, even 2020 is probably even more. Yeah, it is. It's not much, but so since 2019 to 2023, which is 4 years, you've lost 12.4% of your money. So could you imagine? So if you had $1 million in your super, saved $1 million, you're actually $123,505 worse off. So I mean, if you invested your money and over the 4 years, the value of your investments increased by more than 12.4% relative to inflation, your value of your money is still the same. So if your money grew to 1,123,505, if it grew to that amount, then you'd still have the same purchasing power. So, you know, like over the 4 years, if it grew by 12.4%, you'd have equal purchasing power. The only other issue is that, okay, if the money grows by 12.4%, you still got to pay tax on that, because unless, of course, it's like capital growth and you don't sell, but if it's like a dividend or something like that, you'd have to pay tax on that. So if that was income, say you generated income of 12.47% off that money, you'd have to pay tax on that. So you'd lose a big portion of that money. So it's just an indication. Yeah, so this corresponds to an average depreciation of $30,876 per year. That's based on $1 million, but say even if you just go back to 10,000, so basically every year your $10,000 is losing $308. That's not much, but that's a considerable amount when you're adding up that it's $10,000 and you're losing, you know, 0.3% or whatever it is. So then if we go down here, this is the inflation rates for consumer goods in Australia. So you can see how this is 1960, and then the inflation rate on the side here, so it goes up to 21%, and it goes all the way to 2022. We haven't got 2023, but I'd say there's going to be a bit more of a spike there. I think it will start flattening out with the higher interest rates. It's got to have an impact on asset prices because they're trying to deflate the inflation of the dollar. So they're trying to deflate the flood of money, basically. So they're reducing the supply of money in the economy in order to reduce inflation, which then means that asset prices have to come back down to reflect that amount of liquidity in the economy. If the economy's got lots of liquidity, then there's more money to offer towards asset prices. So asset prices have no choice but to go up because people are going to compete for whatever's there. And if there's a shortage, then people are going to pay more to get these assets, because obviously you can't leave your money in the bank because you're going to lose it. So if you look back to 1973, we went up to 15%. I don't think we will get that high. I mean, it'd be interesting if we had a chart of how much debt, which I might put into the video after this one. Basically, if you looked at the amount of debt in Australia in 1973 opposed to around 2021 to 2023, the amount of debt is just crazy. So if they raise the interest rates, say, up, it's going to have more of an impact, because there's so many people in so much more debt today from the low interest rates that they weren't going to raise till 2024. So people were thinking, okay, you can buy assets and even get out, like say this year, or even if it looks like it's going to slow down. But they've just raised them like crazy to try and slow inflation. So if we go down here, so 1974, you got 15%, 15% and 75. So if you lost 15% of your money, if I was to say on $1 million, say, so it's $150,000 that you've lost in your purchasing power. I mean, that's why they want to tax people who have money, but inflation taxes the rich already. That is a tax. It's an invisible tax that you don't see. I mean, you might think, oh, look at that, I bought this and it's worth this. But inflation drives up the price of things, even second-hand cars. You think, how could you pay for that? But it's relative value to the amount of money into supply. So this is just a little part of my little video. I'll be adding it to a bigger video. Thanks guys for watching. Subscribe, support my channel. I'd like to make more videos showing people the different aspects of money and inflation, and teach people how to manage their money better so that they can live a more prosperous life. Thanks guys. See you again next time. Alright, here is a graph of we'll just go back, Australian GDP first to debt ratio from 1990 to 2023. So if we go down here, and basically we're running at 70% debt to our gross domestic product. So basically most of our GDP is fueled by debt. So if you go back to 1990, it was only 12% of GDP, 31 in 1999, and then it just drops down to 09, the amount of debt, and you only just have to have a look. It's just skyrocketed. And if you looked at I don't know what it is, actually I should have a look, but it's at 69.41 in 2020. So if we go back, and I'll find this other page. Well, this chart here is the Australian household debt to GDP, which is gross domestic product that we produce in any year. And if you have a look here, in 2020, it's 119%, up to 122.5%. I think this is taking into consideration of all debt. That has come down. That's probably because of the higher interest rates. Well, basically, yeah. But there's just an indication of how much debt to GDP in household debt, that is. This is the Australian net debt to GDP. So this is government debt. So up till 2020, so basically they were going up to 18.3, and then because of COVID, they skyrocketed, and now they're trying to pull it back. So they're trying to reduce the government debt and pay it off with all the mining royalties that they get, and that they're trying to get rid of. So, which is kind of funny. You use the money that you don't like to pay the debt that you don't like also. So here's a clip from the tradingeconomics.com website. So the Australian household debt to GDP. So if you're looking at the debt from, say, like that 1980s, when the interest rates were really high, till now, which is 120%. It's coming down because people want to get out of debt. But you look at that, and then say the interest rate. Say if you look at, what is it, 40%, that would mean that in ratio terms, if the interest rates were like in the 80s, 15%, because inflation's so high, if you double that, say what the interest rate, say you went to 7%, but see, if you look at the amount of debt, household debt, that is 3 times what it was in the 80s. So basically, that's probably equal interest rates. So if it was around 5%, say 10%, 15% in relation to how much debt there is. So if they raise the interest rates to 8 or 10%, the economy will die, because there's just so much debt. People are in, like, they're spending more money than they have, than they receive every year. They're 120% debt. So this is why raising the interest rates to stop inflation is going to have catastrophic consequences going forward. Guys, thanks for watching. Please like and subscribe.